It makes sense when the self-employment tax savings exceed the additional S-Corp costs. It makes sense when you can justify a reasonable salary that's less than your net profit. It makes sense when you're comfortable with the additional compliance requirements. The new Big Beautiful Bill just made the decision to become an LLC versus an S corporation more important. And listen, if you're still making entity decisions based on 2024 information, you could be leaving thousands of dollars on the table, because I've helped clients save thousands of dollars switching to an S Corp. And guess what? I've also helped clients save thousands of dollars remaining as an LLC. And with new business deductions, the math has fundamentally changed. And I don't want you to make the wrong choice that will cost you time and money. That's why today I will clearly explain the difference between LLCs and S corporations. I will explore decisions you must make before switching, and I will go through math and calculations along the way. But really quick before we dive in, hey there, I'm Sean's clone, a tax professional who personally researches and writes every script you see on this channel. And while Sean is helping people save on taxes, I'm here to share his knowledge with you. And if you have any questions, the real Sean reads every single comment and tries to respond to most. And if you need any help with tax planning, click the first link in the description below, because choosing your business entity can have a massive effect on your overall tax liability. All right, let's dive in. To begin our discussion, we start with the basics of these entities. Chapter 1, LLC versus S corporations, the fundamental differences explained. Before we talk about tax strategies, you need to understand exactly what you're choosing between. Let me break down the core differences in a way that actually makes sense. First, let's define one of the options. What is an LLC? It stands for Limited Liability Company, and it's a business entity you register with your state. Think of it as a legal wrapper around your business that provides two main benefits. Now, here are those benefits in detail. Limited liability protection means that if someone sues your business, they can only go after business assets, not your personal house, car, or savings account. This is huge compared to operating as a sole proprietor where everything you own is at risk. Pass-through taxation means the limited liability company itself doesn't pay taxes. Instead, all profits and losses pass through to your personal tax return. If your limited liability company makes $100,000 profit, you report that $100,000 on your personal return and pay taxes at your individual rates. Now that we've covered limited liability companies, let's move on to the other side of this comparison. The S Corp tax election. When you make this election, the Internal Revenue Service treats your business differently for tax purposes. Instead of all profits being subject to self-employment tax, you split your income into two parts. Here's how that split works. Salary means you pay yourself a reasonable W-2 salary subject to payroll taxes. Distributions mean additional profits are distributed to you without self-employment tax. With those definitions in mind, let me show you how these differences play out in practice. We'll look at several key areas, starting with ownership flexibility. Limited liability companies can have unlimited members of any type. This is perfect for raising capital or complex ownership structures. S Corp has a maximum of 100 shareholders, and all must be individuals with some exceptions. This is restrictive for growth. Next, let's discuss how these entities are run. LLCs lets you choose member managed where owners run it, or manager managed where you hire someone else. This offers total flexibility. S corporations must have directors who elect officers. Shareholders don't manage day-to-day operations. This offers no flexibility. Moving on, we need to consider what it takes to keep these entities compliant. Ongoing requirements. LLCs requires you to file an annual report with the state, maintain an operating agreement, and do basic record keeping. S Corp requires annual shareholder meetings, board resolutions, corporate minutes, stock certificates, payroll processing, and quarterly payroll tax filings. And these tasks can be a big hassle. Another important aspect is how taxes are filed. LLCs have income and expenses flow to your personal return using Schedule C for single member or Form 1065 for partnerships. S Corp must file Form 1120S business return, plus issue K-1s to shareholders, plus process payroll. One of the biggest impacts on your finances comes from how taxes on your earnings are handled. So let's dive into the self-employment tax reality. This is the big difference that affects your wallet. Let's use a simple example to illustrate it. So here's the scenario. Your business nets $100,000 profit. As a limited liability company, you pay self-employment tax on the full $100,000. Self-employment tax rate is 15.3% for Social Security plus Medicare. Your self-employment tax is $15,300 plus regular income taxes on the $100,000. As an S Corp assuming $60,000 salary and $40,000 distribution, you pay payroll taxes only on the $60,000 salary. Payroll taxes on salary are $9,180. Self-employment tax on $40,000 distribution is $0. Tax savings are $6,120 annually, plus regular income taxes on the $100,000. But here's the catch. You now have payroll processing costs, more complex tax filings, and additional compliance requirements. The question becomes whether the tax savings justify the extra costs and complexity. Now that you understand the fundamental differences, let's talk about something most people get wrong, which is trying to switch entities before maximizing the tax benefits of their current structure. This leads us smoothly into our next chapter. Chapter 2, maximize your limited liability company tax deductions before switching. Here's a mistake I see constantly where business owners rush to elect S Corp status thinking it's the magic bullet for tax savings, when they could save even more money by first optimizing their limited liability company tax strategy. The 2025 tax bill has created incredible opportunities for limited liability companies that many people are completely missing. Let me show you how to squeeze every possible tax benefit out of your limited liability company before you even consider switching. We'll start with one of the most powerful tools available, the enhanced sections. 199 business income deduction is your first priority. The qualified business income deduction got a massive upgrade in 2025, and limited liability companies can take full advantage. This deduction alone could save you more than switching to an S corporation. What changed in 2025 includes the deduction now being permanent at 20%. There's a new minimum $400 deduction for anyone with $1,000 or more of qualified business income. Phase-in ranges for limitations increased to $75,000 for single filers and $150,000 for joint returns, up from $50,000 and $100,000. The starting thresholds for 2025 are approximately $197,300 for single and $394,600 for joint filers. For example, you're a single filer with $220,000 in consulting income. In 2024, your qualified business income deduction would be partially phased out due to service business restrictions, assuming old range. Phase out over $50,000, so reduced deduction. In 2025, with the enhanced range, you experience a slower phase out, getting $33,000 deduction instead of less under old rules. Tax savings are $33,000 times your tax rate, let's say 24%, equaling $7,920. Limited liability company advantage is that as a LLC, your entire net profit qualifies for qualified business income calculation. With an S Corp, you have to subtract your W-2 wages first, potentially reducing the benefit. Optimizing your strategy before switching to S Corp includes ensuring your business qualifies, and most do under the new rules. It also includes timing income and expenses to stay within favorable thresholds, and it includes considering equipment purchases that increase your qualified business income. Building on these qualified business income enhancements, there are even more deductions to layer on top. The 2025 tax bill created 3 brand new deductions that come directly off your adjusted gross income. These are available to limited liability companies and can be worth up to $47,500 in additional deductions. One of the most exciting changes is the return of permanent 100% bonus depreciation. Starting January 19, 2025, bonus depreciation is back at 100% and it's permanent. This is massive for limited liability companies because you can immediately deduct the full cost of qualifying property. What qualifies includes equipment, machinery, vehicles. It includes furniture and fixtures. It includes computer software. It includes new manufacturing property with special 100% bonus through 2030. Limited liability company advantage is that the full deduction reduces your net self-employment income, saving you both income tax and self-employment tax. For example, you buy $50,000 in equipment for your limited liability company. Immediate deduction is $50,000. Income tax savings in the 24% bracket are $12,000. Self-employment tax savings at 15.3% are $7,650. Total tax savings are $19,650. Strategic timing means if you're considering S Corp election, make major equipment purchases while you're still a limited liability company to maximize the self-employment tax savings on the depreciation deduction. Closely related to bonus depreciation is another expensing option that's been boosted, enhanced, Section 179, deduction. The Section 179 deduction increased to $2.5 million in 2025 with a $4 million phase-out threshold. This allows immediate expensing of equipment purchases. Limited liability company strategy is to combine Section 179 with bonus depreciation for maximum impact. Use Section 179 for used equipment since bonus depreciation requires new property. Apply bonus depreciation to new equipment. Time purchases to optimize your tax situation before S Corp election. If your business involves innovation, there's yet another deduction to consider, the immediate domestic research and development deduction. The 2025 law allows immediate deduction of domestic research and development expenses, while foreign research and development still gets capitalized over 15 years. Limited liability company opportunity is that if your business involves product development, software creation, or process improvement, these expenses can now be immediately deducted, reducing both income and self-employment taxes. To tie all this together, let's look at how to put these deductions into action before any switch. For example, let's say you have $150,000 in business income. Enhanced qualified business income deduction is $30,000. New above-the-line deductions are $35,000. Bonus depreciation on equipment is $40,000. Net taxable business income is $45,000. Self-employment tax is $6,358 instead of $21,204 on the full $150,000. At this point, S Corp election might not even be beneficial because you've already optimized your limited liability company tax position so effectively. But if you still think it might be, here's when to evaluate it after all this optimization. After maximizing your limited liability company deductions, S Corp election makes sense when you still have significant net profit after all deductions. It makes sense when the self-employment tax savings exceed the additional S Corp costs. It makes sense when you can justify a reasonable salary that's less than your net profit. It makes sense when you're comfortable with the additional compliance requirements. The key insight is don't rush to change entities. First, maximize the incredible tax benefits available to your limited liability company under the new 2025 law. You might find that you don't need the complexity of an S Corp at all. With your limited liability company fully optimized, we're ready to build a framework for deciding if and when to switch. This brings us to the next chapter, Chapter 3, the 2025 Decision Framework. Now that you understand the differences and have maximized your limited liability company deductions, let's determine when switching to S Corp makes sense. The 2025 tax bill has shifted these breakpoints significantly. We'll break this down by income levels, starting with the early stages. Level 1, the startup phase, under $50,000 profit after deductions. If you're just starting out or have optimized your limited liability company deductions down to under $50,000 in net profit, a limited liability company typically makes the most sense in 2025. For a tax calculation example with $40,000 net profit after optimization, self-employment tax is $5,652 at 14.13% effective rate due to deduction. Enhanced qualified business income deduction is $8,000 at 20% of $40,000. Potential additional above-the-line deductions are already maximized. S Corp alternative means you need to pay yourself a reasonable salary. Let's say $30,000, leaving $10,000 as distributions. Payroll taxes on salary are $4,239. Tax savings on distribution are $1,413. Net savings are about $1,413. But consider the costs. S Corp tax return is $2,000 to $4,000. Payroll processing is $1,200 to $2,400 annually. Additional compliance time and complexity are factors. Verdict is stay limited liability company at this level. The savings don't justify the cost and complexity, especially after you've optimized your limited liability company deductions. As your business grows, the calculus changes, so let's move to the next level. Level 2, the growth phase, $50,000 to $150,000 profit after deductions. This is where S Corp election becomes compelling, especially with the 2025 enhancements. For a tax calculation example with $100,000 net profit after limited liability company optimization, limited liability company route has self-employment tax of $14,130 on the $100,000 after deductions. Enhanced qualified business income deduction is $20,000. You've already maximized other deductions. S Corp route, assuming $65,000 salary and $35,000 distribution, has payroll taxes on salary of $9,178. Self-employment tax on distribution is $0. Enhanced qualified business income deduction is $20,000 calculated on business income minus W-2 wages. Tax savings are approximately $4,952 annually. New 2025 consideration is that with enhanced qualified business income benefits and the new above-the-line deductions already maximized in your limited liability company, the S-Corp advantage is more pronounced because you're now optimizing on top of an already optimized tax position. For break-even analysis, annual tax savings are $4,952. S-Corp compliance costs are $3,200 to $6,400. Net benefit is $1,552 to $1,752. At this level, S-Corp election starts making financial sense, but you need to factor in the time and complexity costs as well. When profits climb higher, the benefits really start to add up, which takes us to the next phase. Level 3, the optimization phase, $150,000 plus profit after deductions. At higher income levels, S-Corp benefits compound significantly and you have more sophisticated strategies available. For advanced strategy, the salary optimization play with $200,000 in business profit after limited liability company optimization, you might structure salary at $100,000, reasonable for your role in industry. Distribution is $100,000. Self-employment tax savings are $14,130. Enhanced qualified business income benefits are on the business income. Annual savings are $11,000 plus after compliance costs. The compounding effect is that at this level, the percentage of your income going to compliance costs drops significantly, making the S-Corp election much more attractive. Sometimes your involvement in the business changes, opening up another option, so let's discuss that. Level 4, the passive income phase. Here's something many people miss, which is if you can structure your business as a passive activity, working less than 500 hours annually or meeting other material participation tests, you might avoid self-employment tax entirely as a limited liability company. The 2025 advantage is that with enhanced Section 199A benefits and maximized deductions, passive limited liability company income becomes extremely attractive. You get no self-employment tax on any amount. You get full qualified business income deduction benefits. You get all the deductions you've already optimized. You get simplified compliance compared to S-Corp. When this works, includes rental properties or equipment leasing. It includes businesses with hired management. It includes investment activities. It includes royalty income from intellectual property. Beyond these levels, there are some unique factors introduced by the new law that could influence your choice. This leads us into Chapter 4, Special 2025 Considerations. The state and local tax deduction enhancement impact. The new law increases the state and local tax deduction from $10,000 to $40,000 indexed for inflation, but it phases out for high earners starting at $500,000 modified adjusted gross income. How this affects your decision is that for limited liability companies, state and local tax deduction applies to your individual return and your business income affects the phase-out calculation. For S-Corps, your salary and distributions are both included in the phase-out calculation, but the composition might affect your overall tax strategy. Strategic consideration is that if you're near the state and local tax phase-out threshold, the way your business income is characterized as self-employment income versus salary and distributions could impact your total tax liability. If your business involves making things, there's an extra incentive to factor in. The manufacturing bonus opportunity. If you're in manufacturing, the new 100% bonus depreciation on manufacturing property for construction beginning after January 19, 2025 and before January 1, 2031 creates massive opportunities. Limited liability company advantage is the full depreciation deduction reduces both income tax and self-employment tax. S-Corp consideration is the deduction reduces business income, affecting both salary requirements and distribution amounts. Strategic timing means if you're planning major manufacturing investments, consider timing your S-Corp election around these purchases to maximize tax benefits. For businesses with global reach, future changes could play a role too. The international business impact. Starting in 2026, there's a new 1% federal excise tax on remittance transfers to foreign recipients. If your business involves international payments, this could affect your entity choice. Planning opportunity is to structure international payments before 2026, or consider how this tax affects your overall business model and entity choice. Finally, don't forget that taxes aren't just federal, so we need to think about where you operate. State tax considerations. Federal changes don't always align with state tax laws. Some key considerations include state S-Corp recognition, where not all states recognize federal S-Corp elections or have different rules. They include state and local tax workarounds, where many states created pass-through entity taxes to work around the old $10,000 state and local tax limit, and the new $40,000 federal limit might affect these strategies. They include state-specific deductions, where some states don't conform to federal bonus depreciation or qualified business income deduction rules. With all these factors in mind, it's time to put together a clear plan for what to do next. Let's move to the action steps. Chapter 5, the 2025 Action Plan. Step 1, maximize your current tax deductions. First, take all the tax write-offs you can that are ordinary and necessary to operate your business. Update your calculations for qualified business income deduction with new 2025 thresholds. Plan equipment purchases for 100% bonus depreciation. Implement immediate research and development expense deductions. Then calculate your optimized limited liability company tax position. If you still have substantial profit, then move on to step 2, Model S Corp benefits. Determine reasonable salary for your role and industry. Calculate payroll tax savings on distributions. Factor in S-Corp compliance costs. Consider state tax implications. Analyze break-even point. Then you can look at step 3 and make the decision. If net S-Corp savings exceed $3,000 to $5,000 annually, consider election. If savings are marginal, stay limited liability company for simplicity. If you're growing rapidly, plan elections for next tax year. Step 4, implementation timeline. For 2025 S-Corp election, deadline is March 15, 2025. For the 2026 election, file Form 2553 by March 15, 2026. Late elections are possible but require reasonable cause. You will need to file Form 2553 with the IRS to make the election, and typically you will hear back within 60 to 90 days. All right, now, here's the bottom line. The big, beautiful bill has changed calculations for determining the limited liability company versus the S-Corp conversation, but the key to success isn't just choosing the right entity, it's optimizing whatever entity you choose. The bottom line is there's no universal right answer, but with proper planning and optimization, you can save thousands in taxes regardless of which path you choose. The key is understanding how the new law affects your specific situation and taking a systematic approach to optimization. If you need help navigating these changes and optimizing your specific situation, click the link in the description to learn how to work with a professional who can build a customized tax plan for you. Or if you want to keep learning, check out more ways to save on taxes with this video coming up next. As always, thanks for watching, and I'll see you in the next one.